Citigroup is out with a new note saying that supply chain pressures will persist and that the Russia-Ukraine conflict has shattered any hopes of near-term improvement. Let's welcome in the author of that report, Nathan Sheets, Citi's Global Chief Economist of Research. Nathan, always great to see you. So, no improvement in supply chains anytime soon. What does that mean for the inflation outlook?
The supply chain picture continues to look pretty severe, as you indicated, as a result of some of these geopolitical developments, their implications for commodities in particular. That's exacerbated by uncertainties about production as a result of Asia and China's zero COVID policy and what that might mean for supply chains. And I think that it means for inflation that we're going to continue to see some of this supply shock driven upward pressure on prices. And it's having a very powerful effect on the global economy. And I think that we are clearly now seeing demand destruction. And if there's any light at the end of the tunnel on these supply chain pressures, it's really that this demand destruction is now resulting in a situation where goods spending is starting to weaken. And maybe that's starting a new dynamic that's emerging even over these last couple of weeks. It may over time help reduce some of these supply chain pressures. But that's still a little speculative. What we're seeing is tightness at the moment.
Nathan, one thing that we did hear over the course of this earnings season, and especially so from Lululemon, they said in this global supply chain and with those challenges, they're not going to pay to fly. They were speaking specifically about the footwear category, but I think more broadly for those companies who do have to pay up to make sure that they're getting the necessary inventory just in time or at the right time. How much is that going to continue to compress some of their own margins in the meantime, from your estimation?
Yeah, this inventory picture is exceedingly complicated right now. I think that one dynamic that's at play is that firms in the aggregate inventory levels are all right, but they don't have critical components. They don't have all the inventory that they need of the right kind of stuff. And then I think the corollary to that, as we've seen from some of these retail reports that you're referencing, is the lower income consumer in particular is getting squeezed. And you're in this dynamic of demand destruction that I described. And that's also starting to generate some inventory accumulation. And ultimately, they may need to put stuff on sale. Bottom line here, it strikes me that what we're seeing is the best antidote to high inflation is high inflation, because it destroys demand and helps equilibrate the economy. But that's a painful process. It's exactly where we are at the moment, however.
Nathan, it's Julie here. We are indeed there. It feels like, at least in some sectors of the market or of the consumer spending market, that is. Throw the Fed on top of all of this, if you would, and other central banks that are tightening, because if the problem is sort of taking care of itself, if you will, the best antidote to high prices is high prices, then if you bring the Fed raising rates into that equation, how does that change the dynamic?
It certainly amplifies it. We call this report on the supply chains the complexities multiply. And indeed, that's exactly what we're seeing, is that the Fed is watching the demand destruction. It is observing a slowing in the economy. But I think that its calculus is that, that's not going to bring about the reduction in inflation as reliably or as quickly as we might like. And it may not be as broad-based as we would like. Another dynamic that's at work in the economy as we speak, even as we're worried about some of the goods sectors and goods side of the economy, services spending is red hot at the moment. When we go to the airport, it's hard to get through security. There are long lines. demand for tickets is up significantly. And I think the Fed is looking at the slowing of the goods side, but is also seeing a pretty robust services economy. Putting that together, they've done to hike rates, but I think they recognize that as they hike and as financial conditions tighten, there is real, meaningful recession risk for the economy over the next, let's say, 12 to 18 months.